Hello and welcome to another episode of the Forever Cash Life Real Estate Podcast, where we talk about all things concerning wealth, assets, wealth creation, generational wealth, passive income, those kind of things. And today we're going to have, for the first time ever, a discussion about exchange traded funds and about things like gold. So be super curious, I'm super excited to cover that topic from different angles, and we'll be right back with that.
Welcome to the Forever Cash Life Real Estate Investing Podcast with your hosts, Jack and Michelle Bosch. Together, let's uncover the secrets to building true wealth through real estate and living a purpose-driven life.
All right, so here we are. So our guest today is Will Rhind. And Will, welcome to the show.
Thank you, Jack. Thank you for having me. Absolute pleasure to be on.
Great. So Will is the founder of GraniteShares, an independent exchange-traded fund built for investors seeking simple, cost-effective access to differentiated investments. So they're backed by big VCs like Bain Venture Capitals, Clock Tower Technologies, and so on. So Will has created like an ETF fund, which first question for you is like, give us a little bit of a background of you, and also for our audience, which is mostly real estate investors, also explain what ETF even means.
Yeah, sure. No, I'd be happy to. So in terms of me, I've been involved in the asset management business, the money management business all my career. I'm from Scotland originally, but have been here in the States, New York specifically, for the last 11 years. But I've been involved in asset management all my career. So I got involved in this exchange traded fund business, early on in my career, and really ETFs are like the new technology compared to the mutual fund, which everybody will be familiar with. And ETFs really got going about 20 years ago, and have become a huge multi-trillion-dollar business. And really, they're kind of successful for the same reason that a lot of things have become successful in our everyday lives, particularly on the consumer lives, is because what ETFs represent for the most part is just low-cost investing. And everybody likes low costs. So this is probably one of the biggest things that has driven people into ETFs over time. And of course, there are other benefits for people, such as they're exchange traded. So you buy and sell them just like any other share on the stock market. And you can put them in your brokerage account or in your 401k. And they really give you access to almost any kind of investment that you want. So they become very, very popular. In terms of our particular company, we've been doing this for 3 years now. But like I said, I've been doing this for a lot longer in my career. And I think the cool thing about ETFs is that although they are listed on the stock market, they don't always provide access to stock market investments. So those of you that like real estate, for example, companies like GraniteShares, for example, we offer exposure to some real assets like gold or platinum. We talk about that. But you can invest in all sorts of things. The main point is it's just a liquid, easy way to invest.
Okay, so exchange traded funds, the way I've always heard about them, and again, I'm no market expert because my thing is real estate, right? So I've usually heard it most often mentioned in association with gold. But You're saying it's not only for gold. So it is the exchange traded funds that specialize in what kind of assets, for example?
Yeah, so the largest ETF that you can buy today is an ETF on the broad stock market. So specifically, it's the index of the S&P 500. So those
index funds in the sense are ETF funds or ETF, or am I turning terminology around?
Index funds, for the most part, are just a fund that replicates an underlying index. Majority of ETFs reference an underlying index. So a lot of people can use the same kind of technology or terminology, I should say. But yeah, typically ETFs mean index funds or passive investing, which is investing in an index.
Okay. So index funds, and then ETFs, how do they separate themselves from that if they mimic an index?
Well, think about the ETF as just the fund vehicle. So think about an ETF as just another word for saying a fund. It just happens to be, like the moniker says, it's traded on an exchange, hence the exchange traded part. So like a mutual fund, you can buy a mutual fund that invests in all sorts of different underlyings. or all sorts of different asset classes. And an ETF is no different. So you can have an ETF on gold, you can have an ETF on oil, you can have an ETF on bonds, you can have an ETF on real estate or large cap equities. But you have now over 2,000 ETFs listed in the United States, multi-trillions in terms of assets under management, and pretty much you can invest whatever you want.
Okay, very cool. So now that's very educational. I don't think I knew that. So that's good stuff. So now yours in particularly, which niche in the ETF world did you pick?
Well, we do three things. So in our business, we don't focus typically on one particular niche. And the reason for that is because you get all sorts of different investors that like or have all sorts of different styles. So in many ways, no one investor is the same, and everybody is slightly different in the way that they think about the world and the way that they think about investing. So broadly speaking, there's three things that we do. One is real assets. So real assets would be gold, platinum, which is another precious metal. And then we have broad commodities, which you can invest in, a broad basket or an index of multiple commodities. Then we have income. Our twist on it is what we call alternative income. So that's income that's generated from listed securities that do not pay corporate tax. So REITs, or real estate investment trusts, would be an example of one of those asset classes. And the last thing we have is we have large cap equities. So you can invest in the broad market. Our twist on it is we have a strategy that we try and exclude companies that we think are going to underperform the market over time. And we X out the losers, so to speak, in order to create a fund that hopefully the winners take care of themselves.
All right. So then I'm a very process-oriented person. So your firm owns the fund, and with the fund, the investors invest in the fund, and now the fund buys shares of REITs, or then just selects which ones to buy. That's
exactly right. Yep, exactly right. So we as the company, we are the management company. Underneath, we have a number of different funds. So again, we're no different to some of the big investment brands that people would have heard of. We're just obviously a smaller version of that, more entrepreneurial, but it's the same setup. And ultimately, we have, in the case of our income fund, the ticker code is HIPS, HIPS. It stands for High Income Pass-Through Securities. So within that fund, we invest in a portfolio of pass-through securities, REITs being one of those pass-through asset classes. We have MLPs, master limited partnerships, business development companies or BDCs, and closed-end funds as well. So in that, you own 60 companies, of which those 60 are broken down to those different sectors.
And the investor can choose which of these segments they invest in, or they invest in one and that just has it all in it?
Yeah, they invest just in the fund. So when they buy one share of the fund, what they're doing is accepting the strategy of that fund. And the strategy of the fund is following the index, which is being created to give exposure to those four segments. And literally, you just invest on that basis. And that's the same with all of our ETFs. You're buying into a strategy that's already predetermined, whether that's gold or whether it's the equity strategy we're talking about. So they all work in the same way.
Okay, so you have products that, for example, the gold product that somebody could invest in that is distinct from the income strategy, because obviously all gold is not an income strategy.
That's exactly right. So gold obviously is a completely different asset class, completely different return stream. Obviously everyone will know that gold doesn't pay an income, for example. So literally what happens is in that fund is pretty cool. We actually have a vault, a maximum security facility in London, England, where we actually store the gold bars. And so specifically when you invest in that fund, one share corresponds to 1/100th of an ounce of gold. So if you take the gold price in the market today, a little bit over $1,800 an ounce, you divide that by 100, then you get to roughly the share price of our gold ETF. So it's going to be about $18 a share for easy math. And that means that when you buy a share, you hold the gold.
Right. So why would somebody invest in an ETF for gold, particularly, since I said at the beginning, I'm talking a little bit more gold. how, because I'm not against gold. I like gold. So I own some gold. I think we are in for a inflationary period at some point of time in the not so far distance future. So gold is actually, I'm actually quite bullish at gold even at $1,800 because it's just, you can't print $6 trillion of additional money and without having any, and just send out billions and billions and hundreds of billions of dollars up to the public and ultimately not have an inflationary effect in it.
Yeah.
So which of course right now is counteracted by the deflationary impact of people losing their jobs and so on. But over at some point of time, they'll have their jobs back. The liquidity is still out in the market. So that's going to lead to some kind of an asset bubble again.
Yeah.
And so in this case, gold is a good number. But what is, I'm sure you've been asked this question a million times, but why would somebody not just go buy on one of these places or these stores and buy gold and put it in a safe at home instead of having it in your safe? Like if they need to use it, they can't get a hold of it with you guys. Right?
Yep. No, it's a great question. And look, I think my answer to this is that they're two different investments. And I'll tell you why. So the majority of people that we're talking to are professional investors. They're financial advisors. They're people that manage money for underlying wealthy individuals or for pension funds, endowments, etc. Now, obviously, individual investors can buy ETFs. You just need access to a brokerage account. You go online, Charles Schwab or whatever your broker is, and you can buy shares in the ETF. But for the majority of times, we're talking to people that are using it in the context of a portfolio. And what our gold ETF allows you to do is just own gold in a portfolio of other investments. And the reason why you want to do that, or you might want to do that, is that in that portfolio, you're trying to generate a return. And so your gold plus your equities plus your bonds, whatever else you have in there, it's just a really easy way for people to buy and sell and get exposure directly to the gold price. So when you talk about the gold price, we're talking about the spot price of gold. And the spot price of gold, what that actually really means is that's an ounce of gold that's settled into one of the 4 clearing vaults in London. Now, not a lot of people know that, but that is exactly what an ounce of gold officially is. And we provide access to that specific measure or that spot price. And so that is what's called the interbank price. That's the price that central banks will trade at, big bullion banks, and obviously you and I, if we buy shares in the fund, we can transact at that price. Yeah, and that's unique. So if you go,
a American Eagle or Kruger Run, you pay a premium over that.
Exactly right. So what happens there is a mint, which is obviously part of a government, a mint makes a coin. That coin, they sell at typically a 3% markup to an agent. And that agent then goes and sells that coin onwards to a member of the general public or who else. So by the time it gets to you and you're buying that coin, you could be paying 6 to 10% premiums to buy that coin, as opposed to buying a share in the ETF for basically very little or no premium, other than the bid offer spread.
I was on a gold website just yesterday, and with the gold prices where they are at around $1,800, a American Eagle gold or a I don't know whatever it's one of these reputable companies, the little ones on the one on Gold Bar, costs about $90 to $100 more than the spot price. So yes.
Exactly. And that's a big thing. And what I say to people is, look, there's nothing wrong with coins. I love coins personally, but I like them for personal sort of reasons. In other words, I like to have them kind of to look at around the house. I don't view them as being an easy or liquid investment strategy because it's too expensive. I don't want to pay those premiums, and then when I come to sell them back, those discounts. I want to put the gold in a portfolio very efficiently, just buy and sell, and the ETF gives me the ability to do that.
Right, wonderful. Yeah, that makes total sense. So I from what I hear you say, it's like there's a space for both. Right? There's not.
No, absolutely. They're just two different ways of doing it. There's nothing wrong with with coins. There's nothing wrong with people buying physical gold and storing it themselves. They just need to be aware that there's extra costs in doing that. It doesn't mean it's a bad thing. It just means, in my mind, it's just a different thing that a lot of our investors are trying to do, which is own gold as cheaply and efficiently as possible.
Right. And then also, now do your investors, is there any shape or form that a big investor can say, yes, and I want to actually not just own gold, can you ship me some of it?
Yeah, you can actually do that. So
Yeah.
you can do that. I've been involved in gold ETFs for probably now like 15 plus years. And I count on one hand the amount of people that have asked to do that.
Sure. I mean,
very few.
It's not common, but it is possible. You could say, hey, I got $1 million worth in there. Give me $1 million worth of gold, ship it over here.
Exactly. You have to have a certain minimum size, but really, as long as you've got a gold account, theoretically, you can get that gold delivered. But obviously, very few institutions do that.
Sure. No, absolutely. Yeah. Makes sense. Very cool. So now, how big is your company? How many people do you have? What's your volume? Tell me a little bit about your history.
So we started just 3 years ago. So we're a very young company. And we're growing quickly. I mean, we started with nothing and we're now managing just over $1.2 billion. So we have a lot of money and it's grown very quickly among the 5 ETF strategies that we have here in the States. In terms of the company, we have about 14 people. So I don't know whether people think that's a big number or a small number. For me, it's quite small. But that's the beauty of what we do. Yeah.
The great scope of things, it's probably a small firm, but 14 people managing 1.2 billion is a good number. Yeah.
Yeah, exactly. So we're expanding. We're trying to grow the business, but really, obviously, at this time, as you can imagine, we've just had a huge amount of interest in gold, really since the beginning of the year. I mean, other things as well, but principally it's gold, just because of what's been happening in the economy, and people are really looking for something that's not correlated, which means something that doesn't move in line with the stock market or the bond market. And so that means a lot of people returning to gold.
Yeah, absolutely. And now you're the founder of the firm. What made you start your own company? Let's jump a little bit into the entrepreneurial company.
Yeah, it's a great question. So like I said, I've been doing this really my career. So I'm like the boring entrepreneurial story whereby for me, this is what I do. This is my industry expertise. I just started my own company because I saw a way to do it better and I could serve the investors, my clients better myself. And the only way to do that ultimately is to set up your own thing. So I came at it from being, somebody that had a lot of industry experience. And then the ultimate step for me was to set up my own company, which I did a few years ago. But yeah, I'm not one of these people who just sort of came up with this idea overnight and then suddenly, Flash was an ETF company and launching all of these ETFs.
Right. But so you said you could serve your customers better. How do you serve your customers better?
Yeah, so it's a great question. What your viewers probably won't know about me is that I used to run the largest gold fund in the world. And so that's actually what the job I was doing prior to setting up my own company. So I used to run a fund which is now, it's over $60 billion in size. It's still the largest gold fund in the world. And from my vantage point there, I clearly see that it was amazingly successful, but I could see a better way to deliver a very similar thing to the investment audience. And put simply, again, a lot of people I'm sure this will resonate with them, but I decided to launch a lower cost version or a way to invest in gold. And so the management fee that people pay is less than 50% or 50%, more than 50% less than the fund I was managing prior. And I adjusted other things in terms of the way that security was dealt with and the pricing of the shares and other things which perhaps matter less to people. But the most important things are that we ended up replicating the gold price closer for a lot less money that people are investing. And that was pretty powerful. And so that's one of the reasons that we've been successful.
That makes total sense. And And yes, after running the largest gold fund, at some point in time, what do you do for the rest of your life? Right? You start your own company, particularly if you see ways to improve it. Now that's very powerful. Now, originally you're from Scotland, so tell us. We were actually doing this podcast interview probably backwards. Most people start with the beginning story. I like to jump always right into the subject matter. So, and that's kind of my style. Is like I want to hear the story after I heard kind of like what it's all about. So tell us a little bit about your story from the background. So did you just decide to come from Scotland over to the United States? Or is that some coincidence in there? Or did you come here to college? Or tell us a little bit more about that.
No, I'll tell you my story. Yeah, I'm from Scotland, from rural Scotland in the Highlands. People will have seen the movies, Braveheart, etc. And that's very similar to where I grew up. You know, I could look out of my window from my house and not see anything around. So living in New York City, where I do now, is completely opposite of that experience. So I grew up in rural Scotland. I went to school there, and with school, I'm talking about high school. And then for university, I guess like a lot of kids, I decided actually to move sort of as far away as I could from Scotland or from my home. And so I ended up, in the case of the UK, going to England, and not just to England, but to the southwest of England. And so where I'm from in Scotland, it's sort of like the completely opposite end of the country.
Right.
So I ended up going to college in a place called Bath. And Bath is it's a beautiful Roman town, kind of an hour and a half outside of London. And so I went to university there. And then after that, because Bath itself is what, you know, people would call in the States a college town. So there's not a lot of kind of industry. Well, there's no industry basically there. It's just college and then where you might retire to when you're older. I ended up going to London after university because London is kind of like the New York of the UK. And I got involved in finance. That was the first thing I did. I went into banking, was an investment banker for nearly 2 years just out of college, and then got into the asset management industry. That's how I found ETFs, and then ended up building and managing businesses within the space. And then one prior company, how I ended up in New York was I came to New York to set up their US business. So it was a UK company looking to set up a business in the US. And so I came to the US, I set up their business and ran that for a number of years, and I just ended up staying. So that was 11 years ago now.
All right, that's a fascinating story. And I actually have been to Bath. I think I was a little boy as a family.
Yeah, it's a very beautiful place.
Yeah, since I'm from Germany, we did the trip to England, and I do remember there's some friend of my parents that we visited there. Wonderful, but the Highlands is still on my list, so it's like definitely want to go up there and explore that, and including of course the unavoidable distilleries up there. So
absolutely,
to check some of that Scottish world heritage out, in both landscape as well as liquids. Very nice. So do you drink? Do you enjoy a nice glass of Scottish whiskey up there eventually, or have you become a follower of American bourbon now?
Yeah, it's funny. I do like Scottish whiskey, and I have a few nice ones that I like. I do like bourbon as well, but I just haven't got into it in the same way. And again, it's maybe I haven't tried the right ones, but whiskey's the main thing that I would have.
Of course. I mean, why would you stray from the best in the world there? Very nice. So great. So how can we help you? How can we help you as a community with your mission of spreading the word about that? Is there a website that we can send our audience to, or? Yeah,
GraniteShares.com. You can find us is our website. So just www.graniteshares.com, all one word. You can check out what we do. Like I said, the different funds. If you're looking for income, if you're looking for gold, if you're looking for just broad market, so stock market exposure, we have that. And really, we're just about educating and giving people the education that they need to make better investment decisions.
Wonderful. Now on the income side, because again, I'm in real estate, usually I focus on the gold because I think there's a timeliness to it right now that that with all that printing of money that's going on, which I think there's a time period, we're not going to see much inflation until this is all resolved, but at some point of time, there should be enough swing. But the so to focus on gold, but the income part, obviously at the end of the day, we are cash flow investors. All right. We talk about cash flow, we talk about the forever cash is the name for our podcast. So the income product that you have, does that actually give the investors income? Does it distribute a dividend? Or is it that income gets reinvested and therefore the value of the fund grows and people get their portion there?
Yeah, so we actually distribute the income. That's kind of the main reason behind it, because it's really designed for people that need income first. So the way it works is it distributes an amount of income every month. So it pays out monthly, and we try and generate obviously a high level of income. So right now it's around about 10% per annum, which is obviously very high. But that's a product more of the fact that some of the underlying assets have fallen in value, over the Corona crisis, and so it was a high yielding fund beforehand. It was probably about 7 or 8%, but obviously higher now because the value of the underlying portfolio has come down a little bit.
Which allows you to make investments at the same cash flow for less money.
Exactly.
Right? Okay, very nice. So good. That's good to know, because at the end of the day, I was like, if I endorse you typically anything, then it's like, let's say, a kind of a dividend stock kind of situation where the underlying asset still appreciates, but you get some cash flow from it, because otherwise it's more or less a gamble. And so that would make sense for people to look at, great. So now that income one, is that mostly REITs, or is there other income producing asset classes?
Yeah, right now it's actually the largest component sort of within it is closed-end funds. So that's a different category. And then we have business development companies, and then REITs. So REITs would be the second smallest component currently in it. MLPs or master limited partnerships would be the smallest.
Now, since you have obviously your hands in the market very on a daily basis, you talk to lots of other people. As kind of one of the final questions is, what do you think the next few years will bring in terms of market conditions out there, in terms of values, what are good values, what are bad values? What asset class is going to continue to go up? Which asset class is going to struggle for a while? Like, what do you see market conditions going?
Well, I think that sort of to riff off of something you said, which is very much why or how we've positioned our business. We think that the stimulus that's coming out of the COVID situation means that the money printing, both on the monetary and the fiscal side, but printing more money, all things being equal, leads to higher asset prices. And the victim or the bad news is that the loser in this is the currency. In other words, the value of the dollar will be sacrificed or will fall as a result of all this money printing. And so the lesson from 2008 was, of course, when similar conditions came around, that you wanted to be long assets. And obviously asset prices rose in the period since 2008. And I think the same thing is happening again, which has caught a lot of people by surprise, because remember, a lot of people were very skeptical of the stimulus that was put in place after the 2008 financial crisis, and people were struggling to understand why the stock market was going up and why asset prices were going up when the economy was doing so badly. But I think the one thing that we've learned is that the government money printing influences that in a huge way. And so for my mind, I think that if the stimulus or the money printing continues, you could expect asset prices to continue to rise. I think the difference is that what we're going to see in terms of the stock market and the economy is a divergence between those companies that can thrive in this particular new economic environment and those companies that won't survive. And to me, one of the main sort of differentiators here is technology and the digital, being able to have a digital strategy. And so I think that companies that have a digital strategy and are able to survive in the digital economy. And think about this just very, very simply. When the economy shut down due to COVID, we had really two states. We had the physical economy, and then we had the digital economy. If you were in the digital economy, you were fine. Your business was still open. If anything, you were probably thriving off of that environment. If you were in the physical economy, you were shut down. You were out of business. And so I think that's a big sort of wake-up call that anybody in the physical economy has to adapt, has a digital strategy to adapt to that. And that's going to be the difference between the haves and the have-nots of the market going forward.
Absolutely, 100% agree. I mean, this COVID crisis has taken us, accelerated the digital progress probably by 5 to 10 years, because everyone had to scramble to get a digital strategy, no matter what it takes. That so very, very quickly. Very good. Very good. Wonderful. Well, thank you very much.
Thank you, Jack. Thanks, beyond a pleasure.
Yeah, thank you for being on the show. It was certainly a little bit different, but it's in a good way. I loved it. So I particularly like that you have an income strategy too, because again, we're all about income, all about income generation, ideally as passive as possible, and which you obviously provide, and also timeliness of the goal. So with that said, guys, everyone, this concludes another episode of the Forever Cash Life Real Estate Podcast. Thank you for tuning into the show. And with that said, as always, give us a 5-star reviews, give us a thumbs up, share us. And again, make sure you go check out the website here right now that Will has shared with us, which is GraniteShares.com. Right, GraniteShares.com. We also put everything into the show notes here. And with that said, thank you very much. All right, bye-bye.
Thank you.
Enjoyed this episode? Then make sure you like, subscribe, and post your comments and questions below the video. We're looking forward to hearing from you.